Hi everybody, welcome to another edition of our YouTube videos, Getting to Know BMO. And we thought we'd do a quick switcheroo this week because we thought it'd be interesting to talk about how easy it is to switch mortgages. So if you're looking to change mortgage companies because you see something more appealing on another company, Assad Naeem, my mortgage specialist from the BMO Bank, is going to explain it. Are you having a good week?
So far, so great, Stu. I can't complain at all. It's just a little smoky, but I guess everyone in the city is smoking nowadays. Prayers and thoughts go up to everyone that's affected by the wildfires, and hopefully all ends up well. Other than that, everything's been good. How about you, Stu?
Yeah, it's been good. It's steady. There's still lack of inventory. And then when you go for something, they're opening up offers in 3 days. So your client knows immediately that they're going to have to compete. And I like to think the trick is to get in immediately before you have to compete and try and tie it up with an offer, but it's difficult. It's difficult because, buyers have got to make a quick decision and they've got to be qualified, ready to go shopping, and then it has to kick into gear pretty quick before other people gather around and say, well, I'm going to make an offer on that property as well. So it's not a great time to sell real estate from a realtor point of view, but it is what it is. And I think the market's good at the moment. It'll be interesting to see the CREB report, which comes out of the 1st of next month and tells us what happened this month. So I always look forward to that. And they're pretty good actually nowadays. It comes out on the 1st, maybe the 2nd, depending on how the weekend drops, So then I just thought it'd be interesting. We talked briefly last week, didn't we? And said, well, it'd be interesting to know how difficult or easy it is for a buyer, or a person with a mortgage to switch companies to end the mortgage they've got and sign up with the benefits of another company. So that's your lead in. If you'd explain that to us, Assad, then that would be good. Thank you.
Yeah, by all means. Thank you. It's not as difficult as it sounds. A lot of people are more stressed out about the actual mortgage application process. But at any time where a homeowner or a mortgage holder sees something a lot more lucrative and beneficial to them, it could be a rate drop, it could be a cashback offer, or it could be a different term that they're looking for altogether. For example, people that were locked in on a 5-year term with a very high rate. Now, soon the rates are going to be dropping, as they are right now, and they may want to look for a lower term with a much lower rate. So they might be out in the market looking around to see who can give them what. Basically, it all depends on what type of mortgage you are locked into. If you have an open mortgage means there are no penalties for breaking that mortgage contract. You can have that mortgage paid off at any time and walk out to another financial institution, meaning you sign a contract with another financial institution, you get approved by them, and they would pay off your existing mortgage with your current financial institution. And that's an open mortgage. Pretty simple, pretty easy. Now, for a closed mortgage, it becomes a little trickier because that's where you start looking at penalties for breaking that mortgage contract. Now, if you're in any sort of fixed mortgage term, whether it's a 3-year, 4-year, 5-year, or any year amount of fixed mortgage, then typically for most financial institutions, there is a 3-month interest penalty that you have to pay in order to break out of that mortgage contract. Now, it's always best to check with your mortgage advisor or your financial institution to see what that exact number will be for that penalty. Because some financial institutions, along with that penalty, they also tag on admin fees and other charges as well. So it's always good to be prepared for what you're going to go through. Now, if it's a variable term, meaning it can be a 3-year, 5-year, 10-year, any sort of variable term, that is an interest rate differential. So the penalty is based off of whatever interest rate you have versus whatever the prevailing interest rate will be. And for the remainder of the term, if that's a change, then your interest penalty is based off of the difference of that interest. And it gets very technical. It's easy to say that it's the difference between the interest rates, but once again, you have to check with your financial institution to get that exact number. So it's always good to do a cost analysis when it comes to switching your mortgage and be in touch with your mortgage advisor and get all the details up front before going forward with that. In some cases, your new lender would have an idea of what your penalty would be if you bring them your existing mortgage statement. So they can estimate your penalty, then they can see what the cost analysis will be, how much interest you're going to pay with the new term, and honestly let them know whether it's worth for them to switch or not. I myself have done that many times in the past, and I have been brutally honest whether yes, you should switch or whether no, you're perfectly good where you are, and you're going to end up spending more money looking for a lower rate. And I don't mind telling a person not to switch. It's not all about business, it's all about taking care of the people and giving them the best advice possible.
Yeah, good point. Good point. Okay, well, that's good. We've covered that for people because I'm sure a lot of people think, well, I wouldn't mind moving, but it's such a big deal, you know?
Absolutely. Have a great one, Stu.
And you. Bye bye. Bye bye.